So the Narendra Modi government has been in power for 9 years. And in these 9 years, the stock market has seen record inflows from domestic and foreign investors, and the market cap has tripled from $1.2 trillion to $3.5 trillion. Now, the Economic Times recently featured an article that gives us a list of 44 stocks that have delivered over 1000% in returns during the same 9 years. Our quest here would be to study them as a portfolio and to isolate the reasons for their success so that we can improve our own investing decisions and potentially identify multi-baggers of the future. In fact, over the last 7 months, we've already looked at a number of portfolios and strategies on this channel. We started with a video on coffee can investing. We then looked at Peter Lynch and his small cap investing framework. I examined the magic formula, Ambit Capital's 10-bagger framework, the Monopoly portfolio, a video on Marcellus, and many more which I hope you found useful. This video is a combination of all these strategies, and if you find it useful, then do tap the like button and also leave a comment, as it definitely helps me with the YouTube algorithm. Let's begin. We start first by listing down the variables in our study, and as expected, there are quite a number of them. In fact, I've excluded a few in this list which were slightly difficult for me to discover. Things like market share, P ratio relative to the industry P, net debt to equity, revenue per unit of capital employed, etc. In the interest of priority, I've also excluded some additional but useful variables like earnings yield, free cash flow, ROIC, debt ratio, etc. But when you do your own analysis, don't forget to factor them in. Anyways, we still have a lot to cover, so let's start with the first variable. Right, so sales growth is definitely important, and the bare minimum we are looking for is a 10% growth over the last 10 years. As expected, our superstar stocks have done really well on this front and are averaging a 10-year sales growth of almost 15%. But having said this, there are a couple of things we have to be mindful of. Firstly, a company's sales journey is never linear, and one can expect many ups and downs along the way. For example, there's a lot of recent interest in this company, Olectra Green Tech, and on the face of it, the company has a 10-year annualized sales growth of 31.6%. However, when we look at it on an year-on-year basis, a large part of the sales growth has come in the last 2 or 3 years. So while there is growth, it is not consistent growth, which is why this company won't fit into most of our investing frameworks. The other thing one has to be careful of is that sales as a number is a product of volume and the average sales value. So if the total sales of a company goes up by 10%, then it's in our interest to know the direction in which the sales volume and the average ticket size went as well. For example, in the last quarter of 2021, the FMCG industry saw an overall sales growth of 9.6% in terms of value. However, the same quarter saw a volume degrowth of 2.6%, and the only reason for the increase in sales value was a manufacturer price hike of 5 to 15%. The point is, while sales growth is extremely important, it's equally important to peel through the layers and see why, when, and how this sales growth has come about. The growth in EPS or earnings per share is a fundamental metric and has a direct correlation with any increase in the company's share price. In this graph here, I have plotted the 10-year EPS growth and the 10-year share price return for companies that have a market cap of over 1000 crores, and one can clearly see a positive correlation between the growth in earnings and an appreciation in share price. In fact, when I examine data across 600 plus companies, and I'm strictly speaking in averages here, but any company that grew its EPS by 15.1% in the last 10 years also saw an average share price appreciation of almost 24%. In other words, 1 rupee became 8.5 rupees in 10 years, and this number does not include dividends. Additionally, I also examined the EPS growth and the share price performance of our 44 superstar companies, and what is clear as day is that no company can grow into a 10-bagger with an EPS growth of less than 10%. In fact, the sweet spot is the 20 to 25% range, which means an EPS growth of at least 20% is definitely something a long-term investor should target for. The return on capital employed is a popular metric and finds favor with a number of investors and investing strategies. We see this in Robert Kirby's Coffee Can Investing, where he recommends an ROC of at least 15%. It's also used by Saurabh Mukherjee and the Marcellus team. It finds strong mention in many Ambit Capital reports, and even the Fragility Scorecard uses the ROC as a pillar of strength and robustness. Now, I looked at this number for our 44 superstar stocks, and as expected, a majority of them were above the 15% mark, with the average ROC percentage per last year's data coming to 23.1. In fact, I went a step ahead and examined the metric across different time periods, and what came out is that the top performers have been able to increase their ROC number by a few percentage points over many years. It's an important point to consider because an increase in ROC not only indicates higher profits relative to the capital invested in its operations, but it can also be interpreted as the strengthening of a company's competitive advantage, which therefore makes it a lot more attractive to investors. So point blank, companies with a high ROC number offers investors a better chance of achieving a 10, 20, 30 bagger return. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. Alright, so the PEG ratio was created by Peter Lynch, and it takes the P ratio of a company and divides it by the expected EPS growth rate. So there is some forecasting, some assumption that's required here with respect to the EPS, but as an approach, it's something that uses the valuation of a company and also its growth rate, making it a bit superior to the price earning ratio. According to Mr. Lynch, stocks with a PEG ratio of more than 1 are overvalued, and if this number is less than 1, then these stocks are undervalued. Now, truth be told, I wasn't expecting any of the companies to be undervalued, but to my surprise, and based on current data, there are 8 stocks which are at a PEG ratio of less than 1. Of course, this cannot be looked in isolation, and because the P ratio is involved, it's a very dynamic number, but just to put a benchmark around it, I examined the entire list of Nifty 500 companies, and the median PEG ratio of the broader markets came to 1.4. So if you're thinking what I am thinking, then it won't be a bad idea to look deeply at superstar companies which currently have a PEG ratio of 1.4 or even less than that. The capital employed turnover ratio is something we learned in Ambit's 10 bagger framework, and it indicates how effectively a company is utilizing its fixed assets to generate sales. Now, understandably, a higher ratio is definitely better, but it's still something that depends from industry to industry, which is why, in addition to calculating the capital employed turnover ratio of each company, I have also benchmarked it with the industry numbers that allows for better comparison. For instance, within the agro-processing sector, while Patanjali Foods operates at a ratio of 2.8, Gujarat Ambuja Exports, which is also a part of the superstar list, is at 1.8, while Adani Wilmar and Gokul Agro are far higher and much above the industry median of 3.1. Now, when I did this analysis across all 44 stocks, just about half the companies had a capital employed turnover ratio that was above their industry average. But having said this, when I looked deeper into the data, especially at the stocks that had given a 4,000 plus return, I did observe a pattern wherein the capital employed turnover ratio of those companies was a lot higher than their industry benchmark. I mean, look at Tanla Platforms, KEI Industries, Tata Elxsi, APL Apollo, and also Deepak Nitrite, which means there is definitely something there for us to work with, and having a relatively high capital employed turnover ratio is probably a good thing. Increasing cash flow from operations is important for companies due to several reasons. Firstly, it allows the company to pay for ongoing operational expenses. It reduces the need for external financing or debt. The company can invest in R&D, expand into new markets, acquire businesses, etc. And shareholders like it as they can now receive the benefits of a dividend or buyback. Now, most companies in our list have been consistently growing their cash flow from operations. Some prominent examples include SRF, Balaji Amines, Astral, Tata Elxsi, etc. that have shown consistent growth. But then there are also companies like KPR Mills, Deepak Nitrite, Sonata Software, etc. which have shown multi-year decline, and also organizations like Escorts Kubota and Timken India, where the cash flows have been quite inconsistent. My point is, cash flow from operations is the lifeblood of any organization, and if you can find companies that are able to pump more of this blood, then it does pave the way for creating some nice multibaggers in our investing portfolio. The next test for our 44 superstar stocks is their forensic analysis. The video I made on Marcellus had a list of 10 accounting checks that helps the team understand how clean or how dirty a company really is. Now, I won't be doing all 10, but just as an example, let's look at a couple of them. The first is cash flow from operations as a percentage of EBITDA. By examining this metric, one can identify if the company's reported earnings are truly translating into actual cash receipts, and if not, then it requires more scrutiny on your part, as significant deviations could indicate financial mismanagement or even fraudulent activities. For example, say an IT company sells me a software, and per the terms of the contract, I have to pay 3 lakh rupees as upfront money, and the balance 7 lakhs can be paid every year in 7 installments. Now, if this company follows an aggressive revenue recognition policy, then it will show the entire 10 lakhs as revenue, although I have paid them only 3 lakhs. This artificially inflates the profits of the company, and therefore, as a rule, opt for companies that have a high value of cash flow as a percentage of EBITDA. In fact, I examined this metric for our 44 superstars, and after excluding financial companies, I could see a range of values, and although the average cash flow as a percentage of EBITDA comes to 67%, in my view, this analysis should be done more on a relative basis, that is, examine this number over a period of time and also in line with what other players in the same industry are doing. For instance, I looked at the tier 2 IT companies, since 5 of them were in our superstar list, and from what one can see here, a further scrutiny is definitely needed on Mastech, which has been on the lower side not only in this year but also in previous years as well. A second metric, which is a part of the longer forensic accounting list, is contingent liability, or rather, it's contingent liabilities as a percentage of the net worth. Now, we discussed this in my video on the sugar industry, on how sugar mills often guarantee loans taken by farmers, transporters and harvesters, and if this number goes beyond 20%, then it's definitely something to worry about. Now, for a majority of our superstar stocks, this metric is in the lower single digits, so less than 5% as per screener.in, but there are a handful of companies where this number is 20% or even higher, which in my view is a significant risk that the company is carrying on their books. For example, Sonata Software Limited has given over 350 crores in corporate guarantees to the suppliers of its wholly owned subsidiaries. Which means if you are evaluating this company, then this is one point you will need to investigate further, as it represents a significant risk to the company's financial health in case that liability materializes. And the final part of my review for these 1000% plus stocks is something that we recently learned, which is the Fragility Scorecard. So to quickly recap, we are looking at 4 metrics. The equity as a percentage of total liabilities, and we want this number to be high, which indicates robustness. Break-even sales as a percentage of actual sales, which ideally should be low. Thirdly, there is return on capital employed, and higher is better. And finally, we have cash flows from operations as a multiple of yearly debt obligations plus replacement capex, which also should be a high multiple. Now, I looked at the data, and what clearly comes out is that most of these superstar companies are robust, that is, they are not fragile. I mean, in numbers, the median equity as a percentage of total liabilities is 63%, break-even sales is 22%, which is good. The median ROC is almost 23%, and the CFO multiplier for this group of companies is 1.6 times. However, there are exceptions to this list, and Trent is one strange example whose share price has gone up in a beautiful arc, but at least from a fragility scorecard perspective, there are big issues with all 4 parameters going against what a robust company characterizes. So when you do your own analysis, do watch out for a company's robustness or fragility, and don't forget to make it a part of your own investment checklist. Okay, so what's the point of doing all this? Well, firstly, it's important to recognize that good investing is a series of inputs, and in this video, I have isolated 8 of them in order to understand the characteristics that a 10, 20, 30 bagger might entail. Now, I'm sure this table here looks extremely complicated, and it probably is, but if I were to extract some specific superstar stock criteria, then we are looking at a company that has the ability to grow sales by over 15% per annum, is capable of increasing EPS by over 24% on an year-on-year basis, offers a return on capital employed of 23%, whose PEG ratio is lower than 1.4, although I'm not myself convinced of this point. Number 5, the company has a capital employed turnover ratio which is higher than its industry average. Companies that have been showing an increase in cash flow from operations, companies where the operational cash flow as a percentage of EBITDA is high and their contingent liability as a percentage of their net worth is low. And finally, we want companies that exhibit more robustness as explained in our Fragility Scorecard. So when I applied these criteria on our 44 super stocks, as expected, none of the companies complied with each and every variable. But if I were to identify a viable subset within these 44 companies, then that would probably include a Balaji Amines, APL Apollo Tubes, SRF, Astral, Tata Elxsi, Deepak Nitrite, KPR Mills, Tanla Platforms, Alkaline Amines, and KEI Industries. Of course, all this is based on historical data, but because history does have a habit of repeating itself, I'm very confident this can be a very useful reverse screen exercise. Anyways, I hope you will use some parts of this video to improve your own investing decisions and consequently increase your odds of picking a potential multi-bagger. If you like this video, then do give it a thumbs up, do subscribe to my channel, share this video with your friends, and I'll see you 3 days from now. Until then.